In today's episode of Crypto Over Coffee, I'm telling you why I was very wrong about Ripple XRP, but that is not all. We've got news about the successful Cardano Vasil Hard Fork, more stablecoin drama at Tether, Vitalik Buterin's latest division, and more that you will not want to miss, so make sure you stick around. That said, you know the drill. Grab yourself a coffee, make sure you are subscribed, and stick around for the entire episode we've got in store today. And by the way, please be aware of scammers. I will not reach out to you on social media, in the YouTube comments, or on chat apps. Please be safe. Thank you to Onyx Coffee for the coffee tonic today. Anyways, my friends, you heard the intro correctly. I was wrong about Ripple XRP, a project that I've often made the butt of the joke on this channel and in my quips on Twitter. It's actually one of the most important projects that exists right now in this very moment in 2022. Let me explain. The parent company, Ripple Labs, and their core XRP ledger, RippleNet, and other products are undeniably not designed in accordance with the type of decentralized ethos that something like Bitcoin was, or any number of blockchains that came after it. Heck, let's be fair, Ripple's products were not even designed for the same target audience and use cases that these other chains were. But all the same, Ripple Labs has been fighting one of the most critical battles on behalf of the entire cryptocurrency ecosystem for the last 20-some odd months against the Securities and Exchange Commission, or SEC. In late 2020, the SEC proceeded a lawsuit against Ripple Labs and both its current and former CEO, alleging that the aforementioned parties had broken securities laws in the process of XRP tokens being sold for a sum defined as around $1.3 billion. To be very reductive about this, the crux of the SEC's case is that Ripple Labs offered an investment contract to its token holders of XRP that constituted a security according to the Howey test, which is a framework for determining whether a transaction is subject to the Securities Act of 1933 and its definition of an investment contract that was set as precedent in the Supreme Court case, the United States SEC versus Howey. The SEC claims that Ripple Labs sold $1.3 billion in tokens, which investors believed was an investment in a joint venture business interest. And through marketing and supply manipulation, Ripple Labs led investors to believe that appreciation in XRP's price through company operations would come. It's this application of the Howey test that the SEC believes makes XRP a security. But of course, Ripple Labs does not agree with these assertions. Ripple Labs argues that there is no investment contract between it and its investors. There is no reasonable expectation for profits based on Ripple Labs' activities. And furthermore, Ripple Labs argues that their profits come from, quote, market forces of supply and demand, which reportedly the SEC did not dispute or argue against. At the center of all of this, you have the SEC, which appears to be hell-bent on broadening its jurisdiction over cryptocurrency through enforcement. And the SEC, in my opinion, likely thought that, like other enforcement actions against crypto projects, Ripple Labs was just going to settle the case. They would pay the fine, accept defeat, and move on. However, Ripple Labs has challenged the SEC at every single turn of this case, forcing them to prove, without a shred of doubt, that XRP and other cryptocurrencies just like it are securities. And this past week, news broke that Ripple Labs and the SEC both filed a motion for a summary judgment in court, which allows the judge to make an immediate ruling without a trial as long as there is sufficient evidence to make such a decision without a trial. If the SEC were to prevail in this case, it would cast a massive shadow on a large majority of cryptocurrencies that would almost certainly be reclassified under the new precedent as securities. If Ripple Labs were to prevail, on the other hand, it would weaken the SEC's authority to apply these ill-fit regulatory frameworks and enforcement actions against crypto projects, their foundations, and founders. This would not mean that no cryptocurrencies could be classified as securities, mind you. Just so we're clear, it would just weaken the authority. And if you had told me that Ripple and XRP would be the most critical legal counterpart or would be part of the most critical legal decision for the entirety of crypto back in 2014, I would have certainly not believed you. And I have given Ripple in its entirety a lot of flack over the years, but I was wrong about one thing for sure. Ripple Labs and XRP are acting in the interest of the broader cryptocurrency industry, not against it. And of course, their incentives are aligned here, and that's fine. For transparency, I own exactly 0 XRP. I have no direct financial interest in this case as it relates to the asset itself. However, the facts remain the same. The SEC's mission to protect investors and combat fraud might be just, but its methods in serving this cause have been unethical at best as it relates to its handling and application of enforcement against crypto projects, and that's my opinion. I've said it before and I'll say it again. When you buy a cryptocurrency, you are not buying into a company. You are not buying into a physical asset. You are buying into a protocol that's driven by market forces in which you are just one very, very small cog. It's high risk. It's immature as an industry, but it's a big part of the future. And the outcome of this Ripple case is one that will have a dramatic impact on what the future actually looks like for crypto. And by the way, if you want to hear about yet another example of the SEC's over-the-line enforcement action, you're going to want to stick around for another segment later in the show. It's a really good one. It's the 404 Logic Not Found segment. People like that. Anyways, just make sure you don't click away from the video. So if we shift focus now to another controversial crypto project, Cardano, it just marked its transition to a major new era on its mainnet with the completion of the Vasil Hard Fork this past week. The upgrade that brought several significant updates to the smart contract execution environment and the scalability and efficiency of the network went live without a hitch at all after much anticipation from the Cardano community. And in the wake of this huge narrative around the Ethereum merge, the Cardano Hard Fork Vasil comes at a really apt time because this period of time that lies ahead in the bear market is the perfect time for developers to really put fingers to keys and build top-tier decentralized applications on Cardano. For a while now, since smart contracts first launched on Cardano in 2021, there's been criticism laying towards the relatively slow uptake of smart contracts and dApps on the network. But that's been in large part due to the wildly different paradigm that Cardano takes to smart contract development. It's not as simple as it might seem to port over a complex smart contract from Ethereum and just push it onto the Cardano mainnet. It takes a really different approach to deploy some of the common primitive DeFi applications you see on Ethereum today and push them to Cardano. So things are going to have to be done in a very different way, and developers found that out the hard way. If you're counting on Cardano to not be a part of the layer 1 battle that's to come in the years ahead, you're making a big mistake because it's only getting started, in my opinion. As developers build best practices, as they get the hang of this execution environment, there's going to be some really new and different things being built on Cardano that you can't find anywhere else because of how different the Cardano mainnet is at its base level, but also how the smart contracts are so different as well. So make sure you watch this space. Now, I do want to take a moment to thank the sponsor of today's show, PrimeXBT. PrimeXBT offers a full set of crypto exchange products for the experienced trader, from simple purchase of crypto to high-risk, high-reward margin trading. PrimeXBT also offers trading contests for those who wish to compete with other traders on the platform. Really great for those expert traders out there. But for users who aren't quite ready to dive into the expert level world of crypto trading, PrimeXBT also offers a trading academy platform where one can learn about various topics in the world of crypto trading, from fundamentals to current state analysis and a bunch more. I've actually had Dirk Hardig, the professional trader who leads the education on this platform, on my show before, and he does a really good job of breaking things down in their basics and also breaching some of the more advanced topics in an easy to understand way. So if you want to check out PrimeXBT, in particular the Academy, you can find a link in the description below to explore their offerings. And please note, there are geographic restrictions that apply and that there is a high risk of losses associated with trading cryptocurrency or any other asset of like kind, particularly with leverage or in margin. So please adhere to strict risk management processes and practices and be safe. Now, my friends, do you know what time it is? It is actually 4:04. That is 4:04 Logic Not Found, a firecracker of a segment on the show where we bring attention to the illogical happenings in the crypto space. And if you want to help this show get some attention, please do hit like, get subscribed, follow the podcast, share it with your friends, whatever you can do to help the show. It's really, really appreciated. And again, coffee is one of the greatest drinks on earth, so make sure you're pouring a coffee to drink with me. Now, today's absence of logic is predicated on yet another SEC action that boggles the mind with how diabolical and frankly ridiculous it actually is. But first, let's start with the facts, which are actually a little more logical. The latest SEC case against a crypto person or entity is one that was brought against an influencer, Ian Bellina, whom you might have heard of. The lawsuit brought by the SEC against Buterin alleges that his Telegram messenger-based investor pool back in 2018 constituted an unregistered offering of Sparkster or SPRK tokens that were purchased by US investors in the course of this group investment pool. This, of course, is why the SEC is managing the case, and frankly, it's a pretty straightforward case in that regard. Either they prove wrongdoing or not. It's that simple. The issue here is in the details. The SEC is claiming that it has jurisdiction over this case because, get this, the transactions were facilitated in ETH, and on the Ethereum network, of which they claim the majority of nodes exist in the United States. I mean, are you joking? Regardless of where the transaction originated, the transaction is in the United States because nodes on the Ethereum network are in the US, and therefore the SEC has jurisdiction over it? I mean, that's a pretty ridiculous logical leap if you ask me. But what's most offensive about this is that this little statement of jurisdiction based on node concentration is tucked away in the language of this case material in a very subtle way, and in a way that's not even necessary to make the case. You have clear proof that US investors participated, so they don't even need this language in there. They seem to be doing this just to establish precedent to support other cases, in my opinion, which I feel is very, very sly. In this language, it appears the SEC are trying to claim that because a reasonable number of nodes are concentrated in the USA, that the transaction effectively took place in the USA. And that's a very dangerous precedent to set. Of course, I'm not saying that the SEC is being illogical in doing this. In fact, they're very clever with this move because they're trying to set a precedent in a case that really has nothing to do with what they're trying to say about the Ethereum network's transactional jurisdiction. What's illogical about this is the actual reasoning behind the claim they're making. Because if this, in my opinion, lack of logic is to hold, then let's say I make a transaction through a relay that only exists in Europe, but the transaction originates in the United States. That would mean that the transaction actually happened in Europe, and it's in European countries' jurisdiction for enforcement purposes, right? Because according to this, if the nodes are in the US, the majority of nodes are in the US and it's in the US, so the same thing would be for Europe, right? Unfortunately, things are not that cut and dry in reality, are they? A huge part of establishing the jurisdiction of a transaction is where it originates and who the counterparties are. That's how it's always been. If the transaction originates in the United States and pertains to United States counterparties, then it's United States jurisdiction, right? It's simple as that. Clearly, the SEC does not need to argue jurisdiction based on node clustering, so it makes no sense to claim that that's the reason they're making this assertion to establish jurisdiction. They already have it. It's concerning to me that there's an attempt to expand jurisdiction through subtle language in a case like this, and I feel that many people, whether they're crypto proponents or not, share my concerns here that this is a step too far in a really straightforward case. But what do you think? Let me know in the comments or tweet me at Hashoshi4. In other news, the controversial stablecoin USDT, or Tether as it's called, which is pegged to the US dollar, is facing a little bit more scrutiny in the wake of the hubbub with stablecoins that we've seen in recent times. After the implosion of the algorithmic stablecoin UST brought serious regulatory attention to stablecoins, including those that are presumably collateralized in full, like USDC and USDT. However, throughout the years, Tether has been subject to its own speculation about its reserves and collateral and whether those assets actually are sufficient to cover the issued supply of USD-pegged Tether across the multitude of blockchains that it exists on. Now, a US court has just issued a request for documents that will attest to USDT's reserve assets. Tether claims that it has 68 or so billion of assets as collateral against an estimated 67.96 billion of liabilities in the form of issued stablecoin units. And the court is going to want to have some forensic accounting done to verify against general ledgers, balance sheets, income statements, cash flow statements, and profit and loss statements. This is reportedly part of a much larger and much earlier 2019 legal matter that just coincidentally has come in the wake of the stablecoin drama that we've seen in 2022. But surely, the results of this legal proceeding will be of utmost interest to the crypto investor community, who will hope no sketchy details come out of this as a fact-finding mission unfolds. And I can think of very few worst omens for the already battered crypto markets than another major stablecoin pillar falling by the wayside. And I personally don't think that Tether's going to turn out to be underwater, but you really never know. You just never know in this space. So I'll be watching this one closely, as I'm sure you will be also. And speaking of metrics to watch closely, there is a key data point or metric for Bitcoin and the BTC market that indicates we may be approaching a bottom from which we can spring forth into more sideways trading that will one day hopefully end in a new bull market. And who knows when that's going to be. That said, having a bottom for Bitcoin's price would be a welcoming sight. And this metric that I'm going to talk about tracks the proportion of Bitcoin's circulating supply that is held by long-term holders at a loss. In other words, it measures the amount of Bitcoin that's held by holders who are not in profit on their holdings. So according to data from data analytics company Glassnode, the long-term holders and loss metric here in September 2022 was around 30%, crossing into the threshold that we would usually call the bottom. In previous bear markets and black swan events like 2018 and 2020, we saw this metric land in the 30 to 40% range, which gives some credence to the idea that we may be close to a bottom here in 2022 as this metric tracks towards 40%. But sadly, it does leave room for a drop into the lower 10K range if the trend is to be believed. Now, I'm going to caveat this a little bit by saying that this is the first time in history that Bitcoin, or any crypto for that matter, has stood up to a global recession and a reversal on money printing macroeconomics. So we really can't rely on previous patterns like we used to be able to because conditions are not the same. So we've changed some variables here. We're in uncharted waters, but we're in it together. So we will see how it goes. Do you think it's a bottom? Let me know in the comments. Now, my friends, I've saved the tastiest thought-provoking content for those of you who stick around for Crypto Over Coffee through to the end. Thank you, by the way. The top-tier listeners and viewers, thank you. The co-founder of Ethereum, Vitalik Buterin, just recently shared his vision for the future of the crypto space, outlining what he calls Layer 3 protocols that sit on top of the existing scaling layers, Layer 2s. As if we need another layer to confuse the new entrants in the space, right? I mean, we already have Layer 1s and Layer 2s. We have enough. But anyway, as you probably know, Layer 1 is that base layer, like the Ethereum mainnet, where the security of the network is paramount and it's driven by its consensus mechanism. You get the best security and finality on the Layer 1, but it's expensive. The Layer 2 sits on top of that Layer 1, and it allows for high transaction throughput at low fees for the day-to-day use. And these Layer 2s derive security from the Layer 1 that sits below it. A Layer 2 would be a thing like Optimism or Arbitrum, ZK Sync, ZK AVM, etc. Now, Vitalik imagined a Layer 3, which builds an additional layer of customization and functionality on top of these Layer 2s. And what this means in practice is that one can create an entire subdomain on top of the scaling solutions on Layer 2, such as a privacy application that executes private transactions on a Layer 2, or confidential compute-based business logic layers on Layer 2 for a large enterprise. This Layer 3 would essentially build additional functionality for the Layer 2. Imagine a world where the big businesses of the world build their own domains on top of the popular rollups, which are Layer 2 networks. That would be the mass adoption that we've all speculated about for so long. So I'll leave a link to the whole blog post from Vitalik about this in the description in case you want to read more about it. But it's really interesting to think about what this process, what this paradigm could mean. And remember, make sure you're subscribed, following, and heck, maybe you hit the like button if it's available, because I've got crypto Q&A coming up right up next in my next video. So make sure you're here. It's going to be on the podcast platforms as well. And if you have a question, let me know in the comments or tweet me at Hashoshi4. And in the meantime, check out this crypto video right here that you're not going to want to miss. Thank you so much for watching. I hope you and your family have a wonderful week ahead. And until next time, cheers.